Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Tuesday today. It is April the 18th. I just returned from a weekend in Sarasota. It was kind of fun. A nice place to hang out for a while. And while I was there, I was thinking to myself, I had not made a video on Occidental Petroleum for quite some time. And most of you, or many of you, got to know me as Mr. Oxy about 3 years ago now. But of late, certainly over the last few months or so, I have not really talked much about Occidental at all, other than stripping down their 8 and 10K filings at the end of the last quarter. I'm not even sure I'll do that again because Oxy has kind of become meh, like me too. But let's take a look at what's going on with Oxy. And what I'll do is I'm going to just run through a few let's call them analysis slides with you and talk a little bit about Occidental Petroleum. I'm going to compare it to some other stocks, and at the end of the video, I'll tell you why I am still invested in Occidental Petroleum. So one of the biggest challenges that I have with Occidental Petroleum as an investor are things like this. The Climate Report 2022 is 58 pages of kumbaya. Now, at the end of the day, Occidental Petroleum is an energy company and is a producer. And at the end of the day, really, every time they sell a barrel of oil, they make some profit. And right now, with the commodity price sort of in the $80 range and their cost per dollar, so from a break-even point of view, sort of around 40, maybe 40 something, they're making almost $40 profit per barrel of oil, and they are drilling more than 1 million a day. So at the end of the day, that is their business. All this clinging to green energy and direct carbon capture and direct air capture and all that kind of stuff is interesting. And I understand that they need to show their peers and the rest of the world and the government officials that they are a green energy company. But at the end of the day, building to net zero might also lead to net zero profit. So let's take a little dive here into Oxy. And we'll talk a little bit about Oxy and where I was and where I am now. And then I'll tell you why I am still invested in Oxy today, because I am. Oxy's had a good 3-year run, right? Most of you who've been following me for a few years will know this. At the time, going back to 2020, when I said buy Occidental Petroleum, when the stock price was trading at around, $9, $10, $12, whatever, some people thought I was crazy. And some people took me to task for even suggesting that Occidental might not go bankrupt and it could be a good buy. Well, it turned out that by some stroke of luck rather than genius, I was right, and those people who criticized me were wrong. But I hope that the people who were wrong made some money on something else anyway, because I don't wish ill on anybody, including the people who diss me. So when we look at the stock's performance, I've often talked about this. I said, what are the start and end dates? And I've said many times before that my holding period for a long stock is sort of 3 to 5 years. Now, as you would know, I am at that sort of 3.5 year stage with Occidental Petroleum right now and getting close to, say, 5 years, which is relatively long in the position for me. So now I get to the point where I decide, do I actually exit this position or do I hold it? Now, over the past 3 years, of course, Occidental has been good for us and it's been great and it looked like an industry standout. But if you change the time frame just a little bit, the story starts to change. Well, maybe the $1 million question, or maybe the $10,000 question is this one. If you had invested $10,000 in Occidental Petroleum 3 years ago, sort of today, March, April, what would that be worth today? Now, you can use your own multiplier here, because whether you had invested $1,000, $10,000, $100,000, or $1 million into Occidental Petroleum, the math would sort of be the same. Over the past 3 years, if you had invested $10,000 in Occidental Petroleum, that would be worth approximately $41,000 today. Now, I'm taking this on a date timeline rather than a timeline from the point of view of entering and exiting the position or being lucky enough to time it well, because there are people on this channel who bought Oxy for $9, and my personal cost base is around $12. But if you bought Occidental for $10 and it's currently trading at $60, then obviously you have a 6x, which is better than the $41,000 I'm showing you today, but I'm working with a very specific general timeline. Of course, if you could get a 4x on any investment, that would be impressive, especially when you compare it to the S&P 500. the entire index, which would be something like SPY, SPY, it would only have increased $10,000, would only have increased to about $15,000. Now, that ain't bad over 3 years, but of course, it's nothing compared to Occidental going from 10 to 40,000. If you look at one of Oxy's peers, if I may be as bold as to call Chevron a peer, because Chevron is obviously significantly larger than Occidental Petroleum, $10,000 invested into Chevron would have been worth about $20,000 today. Now, these are stock returns. They exclude reinvested dividends, which is something, as you know by now, I like and I do on an ongoing basis. What does this look like in picture form? So the laggard here at the bottom, almost $15,000, is the S&P 500. So the ETF would be SPY. The 20,000 here, 20,000 is Chevron, and the 40,000 is Oxy. So Oxy comfortably outperformed Chevron and even the SPY S&P 500 ETF over the past 3-year period. But the dividend is important, right? And especially for people like me who not only want to earn a rich dividend, but I also reinvest a dividend, buying more stocks. So as the stocks go down, I'm actually buying more stocks at a lower price. And I like doing that. So the Oxy dividend is important, but it didn't add too much to the return over the past 3 years. And the reason for that is they cut the dividend from 79 cents per share per quarter in 2020 to just a penny, which means actually zero. It didn't start growing again until Q2 of 2022. And after 2 increases, it's only 18 cents per share per quarter, which is very, very low and way below where it was prior to the cut, which was 79 cents per quarter. You may think that the dividend was cut because of the energy crash in 2020, and you may only be slightly right, because that is true only to some extent. What really happened was the combination of those two factors, because it wasn't only the energy crash in 2020, and you can say arguably as a result of the COVID pandemic, but also obviously just months after the ill-timed Anadarko acquisition. And I made a note here saying it was not only ill-timed, but also financially aggressive and debt-funded. And of course, we know they took on $10 billion worth of debt from Berkshire Hathaway, which now almost owns a third of Occidental Petroleum. The dividend is still nowhere near as pre-cut. Now you could say the company, Oxy, is still working currently to resolve the after effects of the Anadarko merger. But really, when you look at it, even after they had paid off so much debt and generated so much free cash flow, when the price of WTI specifically was way over 100, close to $130 a barrel for a long period of time, they only managed to get the debt equity ratio down to 0.63. I say only because even Chevron is at 0.15. The peers in the energy industry have not only been paying back debt, but they've also increased their dividends, and they've been allocating billions and billions of dollars to stock buybacks. And of course, Oxy has done similar things as well, $3 billion in stock buybacks, and they've paid off a big chunk of their long-term debt. But at the end of the day, their debt to equity ratio is still 0.63 times in what was probably a boom time for WTI at over $100 per barrel. So now, if you're an astute investor, as opposed to a day trader, then what you probably might be wondering, what do these numbers look like if you look at the performance numbers pre-acquisition? And this is also one of the reasons why I say my timeline is 3 to 5 years as a general rule. Now, I did not get into Occidental Petroleum 5 years ago, but I did get into Occidental Petroleum 3 years ago, and some maybe 3.5 years ago. If we look at it over a longer period of time, this is 5 years, look how the picture changes quite significantly, right? So now we have Chevron at the top here over 5 years. $10,000 would have become almost $18,000. And this light blue line over here is also Chevron. Now, the difference between the two is simply if you reinvested the dividends compared to not reinvesting the dividends. Chevron would have gone from 10 to 14.5 if you had not reinvested your dividends. Now we find Oxy here in third place with $10,000 over 5 years, simply being worth $10,500. So after 5 years, you would have only have had a $500 return over that period if you had not reinvested your dividends, and at the same time, looking at the performance of the stock over that period of time. If you do not reinvest your dividends, it would have been even worse, because look, Occidental over 5 years, if you had invested $10,000, would only have been worth $9,146,000. Sorry, $9,146 today. So when you look at the actual return on investment over a period of 5 years, Occidental no longer looks like a top performer or an outlier. It looks very, very ordinary. In fact, it's scraping the bottom of the barrel. Over the past 5 years, a $10,000 investment in Occidental would have returned approximately $9,000 on a stock-only basis, so you would have lost about $1,000. And if you had reinvested your dividends, you would have had about $10,500, as I just said. Despite my double speak in terms of $10,500, $1,000, it's just $10,500. The same investment in Chevron would have been $10,000, would have been $14,500 if it's stock only, and if you had reinvested your dividends, it would have been $18,000. So almost 2 times. So if you look at it from that point of view, Oxy has just moved from standout performer to just treading water, or as I've said a couple of times before, there's nothing there, right? Looking at Oxy today, you can buy it at about $63. It's sitting in the middle of its 52-week range. It's not a small company. It's a $56 billion company. It's got positive earnings, which is great. It's cheap. It's got a PE ratio of only 5, pays a little dividend. And of course, it's 80% held by institutions, which is interesting because the majority owner of those institutions is Berkshire Hathaway, who might slowly be moving into this position of just taking over the entire company. So how about this one? It's one of my favorites. I've actually been adding to Devon. I've not been adding to Occidental Petroleum, but I have bought some Devon. You can buy Devon Energy for $55. It too is sitting in the middle, perhaps slightly left of center in its 52-week range. It's a little bit smaller than Occidental Petroleum's $36 billion company. Positive earnings as well, a PE ratio of only 6. The annual dividend, though, makes a huge difference, because whereas Oxy is only paying 18 cents a quarter or 72 cents per year, Devon is returning approximately $5 per share to its shareholders, and a $5 dividend on a $55 stock is almost 10%. So you can see the 9.15 there when you express the dividend, $5.06, as a percentage. At the bottom of the screen here, you can see it's held by institutions, 72%. So very close to Oxy in terms of its 80%, but not quite as high. And of course, not just one single institutional owner that owns the bulk of the company. How about if I compare these 2 stocks, so Occidental Petroleum and Devon Energy, to 3 others that I'm long in and that I hold in my portfolio? This is not in any particular order. It's not even alphabetical, but I own Occidental, Energy Transfer, Enbridge, Devon Energy, and S&P 500 XLE, which is the energy ETF. Right now, in fact, the largest position I hold in any of these energy stocks is XLE, and the largest position I hold in terms of unrealized gains is Occidental Petroleum, thanks to the 5x plus that I've earned on my cost basis, which is about $12. These statistics are always interesting. You can see that Occidental is generating approximately 36 billion in sales with a market cap of 56. It's kind of like average or ordinary. And you can see similarly, you got 41 billion in sales here and an $81 billion market cap, 19 or call it 20 in sales and a $36 billion market cap. But look at this outlier here, which is Energy Transfer. Energy Transfer is generating almost $90 billion in sales and has a market cap of only $40 billion. Does that mean we should buy Energy Transfer, Mr. Oxy? No, not so fast. So we need to look at more than just the benchmarks in terms of sales to book or something like that. You can always park money into XLE if you're not sure. XLE's largest 2 holdings is ExxonMobil and Chevron, and then it holds another 8 or so of the finest energy companies in the United States. So XLE is an easy pickup. But of these other 4, which one would you actually buy? And my answer there is pretty much just Devon right now. If I'm going to add to any of these at all, it would mostly be Devon. You can see the dividends down here at the bottom. There's the dividend I mentioned on Devon, which is 90 cents is per quarter, right? So it's paying well. Well, currently it's generating about $5 on a $55 share. So it's on a $55 stock. So it's almost 10%. And anyway, it's got the lowest PE ratio of only 6.7. What does this look like on a chart? So over 3 years, even if I contract the period to 3 years, and I've just shown you that Oxy over 5 years actually doesn't look that good compared to Devon over 5 years. Oxy looked pretty good, but over 3 years, if I contract the period again, Devon actually returned almost 400% and Oxy just over 300%. Now, of course, it depends on exactly what your start date was here and what the end date is here, but I'm just showing you on a graph that the two outliers here were Devon and Occidental Petroleum. But to be fair, most of the uptick on Occidental Petroleum over the last maybe year or so, I'd say maybe 1 year, has been predominantly as a result of Berkshire Hathaway's occasional buys. Every time Berkshire Hathaway makes a buy, the stock spikes once the market learns about it. Devon has had no such things. In fact, Devon pulled back almost 12% based on its last quarterly earnings report, which is not that great. And Oxy's was not that great either, but Berkshire Hathaway keeps buying it. So it's kind of treading water, and that's one of the reasons why it's fairly level here. It's not going anywhere. It's just kind of flat, whereas Devon took a bit of a hit. But look at the spikes. When Devon spikes, it spikes high, which means the highs are higher, and as a result, the lows are also slightly higher on Devon. That's why it's been an outperformer. Even the three laggards here, the worst performing three, returned a pretty good return on investment over the 3-year period, with XLE leading the charge at 141%, as I said, mainly as a result of Exxon and Chevron. What else is Oxy doing? So this is Vicky Holub, the president and CEO of the company, or CEO of the company. She says Occidental Petroleum is considering bringing in additional partner to help finance, that means debt, at least the initial stage of its ambitious plan to build potentially scores of direct air capture, DAC plants, carbon capture, direct air capture plants, said Vicky Holland. Originally, they said they were going to build about 70. Now they say they're going to build about 135 of these direct air capture plants. This is not their business, so I don't care too much for it at all. This guy that I follow on Twitter, Brian Gitt, you can follow him as well if you want. It's at Brian Gitt, Gitt with 2 T's. He made a comment on Twitter just a few days ago, April 11th, and he said, capturing carbon from the air, not from a power plant or a factory smokestack, is called direct air capture. CO2 is only 0.4% of the air. Using machines to suck CO2 out of the air makes about as much sense as using a straw to suck seawater out of the ocean. And he added this pretty picture down below his tweet, which you will instantly recognize if you are an Occidental investor, because right here in the little thumbnail that I added, you can see this is from Oxy's website, where Oxy says, let's zero in and use machines to suck CO2 out of the air because it makes about as much sense as using a straw to suck seawater out of the ocean. I kind of lean more towards Brian Gitt than to Vicky Holub. So why do I still hold Oxy in my portfolio as one of my long positions? Well, the first thing is, which I now mentioned already, my cost basis is about $12. The shares are currently trading at about $60, which means I have a 5x return on my investment, which obviously is pretty good. The dividend, it still pays a dividend, and that dividend for me is 72 cents per year per share. I do reinvest all my dividends, and if you do the math, 72 cents a share divided by a cost basis of $12 is yielding approximately 6%. So currently, if you really think about Occidental from my point of view, even if you ignore the 5x that I added at the top here, if you can yield 6%, it's almost like a high interest savings account. And pretty much that's how I think of Occidental right now. It's sort of a high interest yield savings account. However, there is a really good chance that Berkshire Hathaway may take the whole thing. And if they do that, and if they aggressively bid for it, what is the target price? So if they had to say to the shareholders, I would like to buy Occidental Petroleum and I'm prepared to pay $75 per share, then they may get some pushback and they'll have to increase the price maybe to $80 or something like that. And if we're lucky, it could even be $100. I'm not sure. But if Berkshire Hathaway takes over Oxy, I would very gladly exchange my Occidental equity for Berkshire Hathaway equity and hold that instead, and just park it in my savings account. Of course, I have a huge tax liability on those realized gains, because if you have a 5x ROI, then you have to pay tax on it if you cash it out. And that's one of the reasons why I haven't cashed it out. And then finally, there is still some upside. Perhaps we see Oxy gradually creep back to around $70, $77 per share, which is more than 20% upside. So for these reasons, I can hold it, in addition to the fact that because my cost basis is so low, even if Oxy pulled back to like $48, I'm still up 4x. So that's not too bad. So that's what Oxy is doing, and that's what I am doing. This climate report is 58 pages of very, very sophisticated nonsense. And that's one of the reasons why I am kind of toning down my previously aggressive investment interest take on Occidental Petroleum, and also one of the reasons why I have not been covering Occidental Petroleum too much of late. But anyway, guys, those are my thoughts. So why don't you tell me what you think in the comments, and we can compare some notes. I don't mind if you tell me I'm wrong, and Oxy is the greatest thing since sliced bread, and we should still get in. And by the way, in this particular video, I am not really talking to the people who hold the majority of their investments in Occidental Petroleum in warrants. I'm specifically talking about long Occidental Petroleum investors, and especially those with, like me, fortunate enough to have a low cost basis and relatively high return on their investment in terms of the 4x, 5x, 6x that you've generated as a return on the stock. So let me know what you think, and maybe on the next topic I'll talk a little bit more about going nuclear instead of focusing on traditional energy. That's it for now. Thanks for watching. Take care. Bye-bye.